Okay, good evening. This is Peter Resnick from ShadowTrader.net and the Weekly Options Room. And in this shadow short video, I want to talk about specifics of how I am trading gold right now in this upward environment. Okay, so first things first is I am taking a very two-pronged approach to the gold trade in that I am taking a short-term approach and also a long-term approach. So let's talk about the short-term approach first. And what's important to note is that in order to effectuate this, you have to use different instruments in terms of the future. So what we're looking at here is the gold futures. And we're going to talk about the short-term first. And what I'm using here is the GCV contract, which is not the front month in gold. Okay, if you understand, if you look closely here and go just punch in just GC and nothing else, you can clearly see that the active contract is actually the Z contract, which has 79 days to expiry. And look at the volume. Obviously, it is the biggest volume, correct? However, this V contract here has 13,000 contracts every day, and it is still pretty active. And why am I using that one for the short term? Because if you punch in the Z contract, you will notice that the options chain does not have daily expiries as of yet, correct? It is only 3 here in September, and when you look at October, it's just by the week. It's just once per week thus far. Whereas when you look at the V contract, you can see what the expiries look like. They are daily. Look at everything that's going on just in the month of September. It's every single day, Monday, Tuesday, Wednesday, Thursday, Friday, which is wonderful. So this is why I'm using this contract here to speculate. So let's just talk about the speculation first. How am I speculating? I'm doing that in two ways, and that is by selling puts. So I want to be short puts, so sell puts. And then I also want to do covered calls. And I will say right off the bat that I am not a fan generally of covered call strategies, but I am a fan of it only in gold. And for those of you who don't know, covered call is one of the most simple stock strategies, basically, wherein what really only matters in any covered call strategy is if the stock is moving up. Because the mistake that people make is they have stocks that go like this and they sell covered calls up here, and the amount of the decline in the stock will far obliterate whatever premium they may have received up here, and the whole thing turns into a loss, and then they have to wonder, well, do I then sell the stock here at the lows or whatever? So your first premise is just simply that you have found an instrument that you believe is going to be either hard up or sideways to up at worst, meaning that it is not going to fall apart. So just start from that thesis. It's very important that I'm starting from that thesis that of course there are risks to selling covered calls or selling naked puts in anything, but we are working from the premise that right now is a very, very bullish time for gold, and I think it's only going to get more bullish, and it will continue in this trajectory. Okay, so that being said, what am I doing is I am selling puts and doing covered calls. Now, this is the position currently. What I want to show you is, given where gold is now, I do not have interest in doing the covered call right now. Why? Because I feel gold is too high. I need to have gold consolidating or pulling back. And one of the first places I would be looking for as a pullback would probably be the 8 EMA, which is right here. And then there's a 21 EMA right here, and then I know that I've got this breakout point right in here. So in any of these areas on a test, I will probably do the covered call. But before that, since I'm not getting that, I'm doing the put sale. Now, speaking of the put sale is obviously more lucrative and safer if gold goes down, which it has not really done very much yet, except you have this little move down today. But since I am interested in owning these futures anyway, why wouldn't I be a put seller at the levels, right? Like here's 8 EMA and here's 21. Why wouldn't I be a put seller at these levels where I want to eventually sell calls against those contracts anyway. The answer is I should be. So hence, I'm a seller of those puts there for now. So you can see right here, this 8 EMA is right here at 35.70. And then there is this level here at 35.90, 34.90, which corresponds with the breakout point. And I'm going to call that the 3,500. So if I go back in here, you can see what is my current position for now is short these, which are at 35.80. And that's just one day, which would be here. And then on the 3500s, because there really isn't premium in one day, it's much further down. It's 140 points down from here. I'm going out 3 days and I'm doing this. And this is a fantastic rinse repeat because you have to understand I am doing this daily. You know, you can look at this very quickly and say, oh, well, that's 500 bucks at 96 cents. And this is going to be, another 900 bucks or whatever. Very often I can do this just in one day. This one happens to be 3 days, but very often I can do this just in one day. And I can just rinse repeat this over and over in one day. And I'll figure out what the size is that I'm comfortable with. Usually I'll go up to about 20 if things go awry. Now, obviously I have to address the elephant in the room of what happens when it crashes down through. Well, that's why the size is what it is. This is why I start small. And I would put on, say, 5, and if it crashes down through, I would find another spot to sell another put and do another 5, etc., and build the position that way. And again, with the sort of idea going forward that gold is not going to crash. And even if there is some stronger pullback here, I don't believe that pullback is going to take us any lower than this breakout point. And regardless, wherever I am building a futures position that I will then start selling calls against. So let's talk about that, which obviously I don't have an example to show you because I'm not selling any as of yet right now because I'm not in that position as of yet, but I probably will be on any pullback, right? Let's look at what I do is then I look at DTE1. So I'm doing it every single day for the next day. And I've very often had periods where I've literally rinse repeated this trade like 4 times in 1 week. Okay. So now, if you can do this math, look at the at the money call right here for 1 day. It's $11 in premium. So this means on every contract, it is 1,100. And in the example of if it was just 5, it would be 5,500 per day. And again, I know all the risks that are out there, so don't leave me any stupid snarky comments about what if it crashes, whatever. I've already gone over that. So just don't even bother because I've already addressed that before. What will happen is, if so, this will go out worthless and I will buy another 5 lower and I will lower my basis down to say 36.20. And then I will look for the call to sell. And again, I'm just exploiting the fact that I believe gold is not going to crash and that I will be able to keep doing this. And I've been doing it successfully for a long time since gold has been able to rally. Okay, so that is the two-pronged approach basically on the short term. As I was saying, there are 2 approaches here. Is that we want to be doing something on the short term, which again, I believe is the covered call play or selling the put premium over and over. And then you want to have the longer term approach. And in this longer term approach, where I've just switched accounts, notice that the contract that's being used is different. Now I'm in the Z contract because I want it to be more long term. And again, trying to build the position. So in this case, I was only able to get off 5 at around 35.50 when the breakout was occurring, and I'm long some GLD shares. That's not really an options position, but it's the same thing, right? This is synthetic gold as it is, so I'm just long gold, right? So this is going to just work out just fine over time. But the main reason to show you this is just the simple fact that this is the December contract, and you want to be using that. Now, from a technical basis, where would I be adding? I already have a limit order in where I know I'm long those 5 contracts already, but that's not the size that I want to have if my outlook for gold is going all the way out to the end of the year, basically, all the way out to that December contract. I believe we're going to see at least probably through the 3,800 number or something like that. And I can certainly make a decision later on if I want to be a seller, if I want to hold and see if we go to 4,000 or whatever. But given the environment that we're in, and if this, this weak labor market has the Fed cutting rates 3 times between now and the end of the year, there's potential that we see much, much higher. But you can see here, where's my next limit order? As I showed you, I'm already long 5. Where's the next 5 going to come in? Right here at the top of this breakout level. This high is 3585.8, and this limit order is sitting here right at around 3587, right in there. Okay, so that just makes sense. It's all very, very technical, and probably if it breached that, I would be a buyer again, probably here. Another 5 contracts here at a level that is right at the top of these. I find that gold can be very, very technical over time and respects these, prior highs, technical levels very, very well. So that's the type of thing that I would be looking at. All right, so that in a nutshell is exactly how I am trading gold. And again, I'm taking a 2-pronged approach in that this one, if you think about it, the longer term, you can think about it as in terms of wealth and income, where like the longer term sort of builds wealth, but the shorter term is one that you make good income from over and over. And like I was saying, why this one here is so attractive is because you have an instrument here in the V contract, not in this one, but in the V contract, where you have daily expiry. And that's what makes this so exciting, is that not only can you just do that rinse repeat over and over and sell those puts, do the covered call over and over, but it also gives you a lot of leeway for how you can get yourself out of trouble, right? You've got a lot of different things that can be done if gold was to have an adverse move lower, which I'm sure it will. I'm sure there's going to be some, move down. Obviously, things don't move in a straight line, and I'm fine with that. But those daily expiries just give you so much more ability to manage that trade. There's so much more versatility there, because think about it. You've got something going against you. For instance, a perfect example would be you can then sell calls on a daily basis and bring in, say, maybe you're not bringing in that $11 or whatever, but you're bringing in somewhere between $2 and $5 or whatever daily. If you do that 3 or 4 days in a row, think of how much you've already brought down your basis, right? In a big way. You may be able to bring your cost basis down by $15 or whatever, which is huge. So there's a lot of versatility, I think, in using that V contract on a daily basis. And then, of course, you want to use that Z contract or GLD for the longer term hold, which I think should be held at the very least to the end of the year, because I think there's going to be some serious price appreciation. All right, that's all. Take care. Hey, this is Peter from ShadowTrader.net, and I just wanted to thank you for watching this video. If you enjoyed this content, please hit the like and subscribe buttons. And if you'd like to trade live with me every day in my weekly options advisory, then check out the link in the description below. I wish you good trading, and I'll see you in the room.